I wanted to take a look at the difference between financing a home for owner-occupied and financing a home for investment property. And the reason I say that is because I often get clients that call me and say, hey, Zevi, I'm thinking of buying this investment property. You think you can help me out with it? And then we talk about their down payment options, and they're under the impression that the same down payment options that apply to owner-occupied actually apply to investment properties, which isn't the case. So that's what I want to cover in today's video, the differences between financing an owner-occupied transaction to somebody who's thinking of getting into the investment game and starting to purchase investment properties. My name is Zevi and I'm an owner of a company called Loanbrook Inc. We're a wholesale mortgage company in Los Angeles. And if you're trying to understand the difference between the two financing structures, then you're watching the right video. With that, let's get started, all right? I want to illustrate the difference for you so it's easy to see. And what I'm going to do here is create two charts. And then one of them is going to have owner, right? And the other one's going to have investor. So, what are the two big differences between these two groups? Now, mind you, the big opportunity that you get to own real estate, which if you do nothing else, personal opinion, I believe that you should take advantage of trying to purchase your first owner-occupied property. And the reason I say that is because there's a very big difference between owning something that, again, coming in with a minimal down payment, leveraging. Let's use this example for a second. Say you bought a property for $300,000, and as a first-time home buyer, you're able to put down, I'm just going to use round numbers. It's 3.5%. Say you're able to put down 3%, right? Let's just use $10,000 for an example, all right? Which it's not. It's 9, but again, using round numbers for a minute. If I'm able to buy a place for $300,000 and basically put down, 3.5%, which is, I guess we'll just, we'll use the right numbers here, somewhere along the lines of 10,500, something like that, as my down. If this property appreciates historically at 5% annually, this is what appreciates 5% annually, the 300,000, which means that the money that I put into the property, which was say 10,500, something like that, right? This would be your 3.5%. I've already gained it back year one if this thing appreciated 5%. My point is, if you take as an example, if you take 10,500, you put in the stock market, and in 1 year that money doubles and you've made 10,500, that would be amazing. But that's because you're only leveraging whatever it is you put in. Over here, when you're buying, with a small down payment like 3.5%, you're leveraging 300. So when 300 moves even 5%, you've already made your money back. So it's off topic for this, but since we're talking about owner and investor, I just want you to realize the opportunity. This is where people are able to build wealth over time. This doesn't happen overnight. And you might say, well, the market is a little slower today than it was a couple years ago. It doesn't matter. If you look historically at where the market has been 20 years ago, 30 years ago, 100 years ago, and you look at today, as an investor, again, we're discussing investment properties. I think this would be an incredible move if you've done nothing else. Just buy your primary residence. All right, so that's one. And so let's discuss coming into the transaction, right? Whereas here, we just said you can come in with 3.5%. Now, 3.5% is designed for somebody who's a first-time home buyer. All right, you could still put down 5% even if you're not a first-time home buyer. And the irony of that is that I don't encourage it, because at 3.5%, you're at max leverage, meaning that you're financing 96.5% of the property. Now, if you don't have any other option, take advantage of it, no problem. But you also have mortgage insurance. And like anything else, whatever it is you insure, the more of it that you insure, the more you pay. Same thing on the premium, right? So if you're able to buy a property, even though this is available for first-time home buyers, with 20% down, I would encourage that a lot more than putting down 3.5%. So let's continue. There's a lot of things between these two that I want to cover with you. All right. When you're coming, now this is for our owners, right? The 3.5%. When you're coming into an investor, the down payment is anywhere between 15 to 20%. So that's quite different. And then when borrowers are calling me and they're saying, hey, Zevi, I'm excited to buy my first investment property. Can we get started? My first question is, are you aware that it doesn't flow the same way that owner-occupied flows? I mean, you don't have these small down payment options. You're basically between 15 and 20%. Are you okay with that? If the answer is yes, if they have that money available, fantastic, let's move forward, all right? So there we are. This is the down payment. All right, so we've established that you need more money to put down for an investment property than you would for an owner-user property. Now, let's talk about something that's going to be really important to you as a buyer, which is the interest rate. Now, there's going to be a significant difference between the interest rate that you're going to be able to secure on an owner transaction than an investor transaction. Now, without actually looking at interest rates, because I literally just priced one before this particular scenario got started, and what I've noticed that on a purchase of $300,000, the difference in rate was about at par, which I talked about in a different video, which is basically the cost of money, the direct cost of money of the lender, which is passed on to us, being at around 6.5% today, which is in June 2024. This actually ended up being closer to a 7.99%. All right, and again, these are hovering rates. This was about a 20% down payment deal. And so you could tell from these two numbers, I just wanted to get a feel of where the market is, that there's about a difference here of 1.5% greater on rate today on investment property than there is on owner-occupied. And you know, that might change depending on where the market is. There has been times where the difference between investor rate and owner was like 0.5%. And so I guess a lot of it has to do with where we are in the market and what is the appetite of whomever it is that's buying these mortgages after they get funded. And in most cases, nationally, that's Fannie Mae and Freddie Mac, and they're government-backed agencies. So they buy these, and the nice thing about it is no matter where you are in the countries, the guidelines are national. All right, so it's all basically the same thing. So we talked about down payment and we talked about rates. All right, as you can see, significant differences. Let's talk about credit for a second. All right, so to get started right here, now again, I'm not talking about an FHA loan. I'm talking about a conventional deal. So FHA being completely government-backed, whereas these are agency loans, like I said, Fannie and Freddie, all right? We're not gonna get much into that. But 620 is the minimum FICO scores here. 620 is the minimum FICO score here. Now, something that you wanna keep in mind, which is important, remember how I said down payment 15 to 20%? 15% if you have a 680 FICO score. If you have less than a 680 FICO score, then you're at 20%. All right? So FICO does play a very big part of, you know, financing. And in addition to it, the rate is tied to the credit score and the loan to value. So you might say, oh yeah, but my friend got, this rate. Yeah, how much did he put down? What's his credit score? All these things are going to matter. Next on our list, I want to talk about the assets, all right, the assets piece, which is important. Even though we said that you can come in here with a 3.5% and over here, 15 to 20, when we talk about assets, these assets need to be seasoned for 60 days. All right. Now the funny thing is, these as well, okay, seasoned for 60. So both of them need to be seasoned for 60 days, but there's a huge difference here. Because here, if you don't have the money in your account that's been there for 60 days, then you can't buy the property. Over here, as a matter of fact, if you don't have the money, you can actually get a gift fund for the down payment from a family member. All right? There's no gift funds that are allowed over here. And over here, you could actually get gift funds, which changes the whole picture. In addition to it, over here, more than likely, you're gonna need reserves, okay? So, and these reserves basically, I believe typically 6 months, and I guess a lot of it has to do with the findings, but 6 months, I'm just gonna put that out here, and this also has to do with the loan amount, it may be more depending on the loan amount, of you not only having these 60, the down payment available in the account for 60 days, the money for closing costs, in addition to it, money that you can show that you can pay this property for the next 6 months, so the lender knows there's no problem with the ability to repay. All right, so these are the basics, the real basics of the differences between me wanting to buy an owner versus an investor. There are other options available in the market for investor, and they're called DSCR loans, debt coverage ratio, where they actually wouldn't look at any of your personal stuff. They would just look at the income coming from the property. All right. There is one other thing that I want to address with you guys when it comes down to owner versus investor, and then we're going to wrap up the video. But I think this is a very important thing, and you should really pay attention to this, because this is a big benefit as it pertains to you buying investment properties, right? So we have the owner and we have the investor. Now, mind you, this is the income piece. It's very important. When you're talking about owner, you qualify typically 45 to 50% debt to the income, right? So whatever there's proposed debt of this new mortgage that we're gonna get from this purchase of $300,000, whatever it is, and including all of your liabilities that you have listed on your credit report, all in, they cannot exceed 45 to 50%. And when I say 45 to 50%, it's because it's an automated decision that runs through the system. It's called a DU or an LP, depending on whether it's coming from Fannie Mae or Freddie Mac. And it's got to spit out an approval. So when it does that, and all your expenses and the housing expense all put together is less than 50%, then you're going to get a conditionally approved transaction, right? Whereas here, although you're doing the same thing, 45 to 50% of your income is being used, there's a kicker. And that kicker is you get to use rental income to qualify. So it becomes a lot easier to qualify. Imagine this, you have this property that's $300,000, right? And the mortgage on it with property taxes and insurance, let's just say, is $2,000. This is your expense. I'm just using some hypothetical numbers. If this property can rent, for an example, just using an example, for let's just say $2,400, all right? Then the lender, this is the expense. If it can rent for $2,400, this is your rent, okay? Then the lender will actually use 75% of the rental income because there's expenses, all right? So if I take this, that would be $600 less. So $1,800 would be the credit. It would be for the rental income, all right, for the rents. Therefore, I would take the expense minus the credit, and it would only hit me for a $200 expense. So think about it. You look at my income and expenses on my credit report to qualify me for 45 to 50%, and then by buying this property, the only other expense I have is a $200 expense. It's a lot easier to qualify. So that's why investment properties, even though the rate is higher, you have to put more of a down payment. You need to make sure that the funds are seasoned for 60 days and there's no gift funds allowed. But when you factor in the rental income, then it makes it easier for you to go ahead and occupy to go ahead and buy the property, all right? So hopefully that makes sense to you. If you have any questions, I know we covered a lot of stuff here. Please make sure, put it in the comments below. I'll be happy to answer it for you. If you want to go over this scenario over the phone, in Zoom, whatever it may be, then feel free to give me a call. 818-697-8220 is my phone number. You can reach me. I'll be happy to run you through owner or investor transactions, whatever it may be, all right? If you enjoyed this video, I would really appreciate it. If you press the like button, it would simply allow this to get pushed in the algorithm so other people like yourself who are interested in this topic or maybe trying to take upon this journey themselves have access to this video. And if you want to see more videos like this in the very near future, then please feel free to subscribe to my channel. Otherwise, I really appreciate you watching this, and I'll catch you again on the next video. Take care.